My name is Anthony Aboud. I am the Deputy Head of Equities at Perpetual. I am the Portfolio Manager for the Industrial Share Fund, the Share Plus, and also the Pure Equity Alpha Fund. I joined Perpetual in 2012, where I started as an analyst. I sort of helped out on the Share Plus Fund, as well as we launched the Pure Equity Alpha Fund at that point in time. What it means to take a short position is essentially I'm borrowing stock from a prime broker, and with the idea that I will buy it back at some point in the future. The idea is that I'll buy it at a lower price, in which case I will generate a profit, but it doesn't always work that way. Why does this benefit a long-short strategy? Well, the idea is that for a long-short strategy, is not only are you trying to generate alpha on the long side of the portfolio, but if you see an opportunity where you think the share price is going to fall, you can actually generate absolute return and alpha from picking that stock falling. Why I think a long-short strategy is relevant is I feel that over a long period of time, the market's generally gravitated upwards. That may not be the case going forward. And so we feel that if you can generate returns both from the long positions and your short positions, it's possible in a market which goes flat to down that you can generate return. But it's not without risk. Shorting is quite a risky strategy. I wouldn't try it at home. What you get is that you can only make 100% on your if it's a winning position, but you can lose multiples of money if it goes against you. So therefore, you need to be really tight on risk management when you're looking at the short side of the portfolio. When we're looking to short, we're looking for red flags, and what we mean by that is that we believe that either consciously or subconsciously, management teams know problems ahead of the rest of the market. So we're analysing their behaviour to work out whether there's troubles afoot. Yeah, the red flags we look for in shorting are, first of all, we look for insider sales. So when a management team or board of directors start selling shares, we think it's not a bad time to reassess that company. The second thing we look for is a turnover of staff. We feel that when a CFO leaves, for instance, it's a big red flag. Next we look for is strange acquisitions, or we call diversification, where a company makes an acquisition where we feel that it's off strategy, or they bought something from private equity. It's something which we sit up and take notice of. Then there's some behavioural attributes of a CEO. CEO's in the paper every second day, talking about how things are going. Just go run your business, or a CEO who berates analysts who've got a sell recommendation. Then we look from an accounting perspective. We've got the ability through our team of analysts to spend a lot of time on the accounts, and when a company presents earnings which are better than actual real earnings, then that for us is a red flag. And finally, if the company's got a strategic review or changing strategy every 6 months, that's a red flag, because we sort of companies don't change every 6 months. The key features of the Perpetual Share Plus Long Short Fund are, first of all, it's part of Perpetual and everything which comes with that. With the long history of running money Perpetual has had over the last 50 years plus, with the current deep analyst team who forensically go through the market and find good opportunities, and then do detailed due diligence to be able to take advantage of those opportunities in the Australian market. The second key feature is the fundamental analysis, which is done. There's a fundamental value long-short fund, which not many of them are around. And we look at things from a fundamental basis. We've got a process in place where we focus on quality and value, where we filter out companies which got too much debt or poor management or unsustainable. The third feature is the fact that it's got the ability to short. And with that, you've got a manager who's been shorting for almost 20 years, which is a big advantage when it comes to tricky markets. There's quite a few points of differentiation when it comes to Perpetual relative to other fund managers. I think first and foremost is the fact that it has that history. It has had funds which have run through many business cycles and has come out the other side in a strong position. There are a lot of fund management companies which do fall by the wayside every cycle. The second thing is that we've managed succession extremely well. I believe one of the most difficult things of funds management over time is managing from one head of equities to the next. over these last 3 or 4 decades, we've managed to go from one head of equities to the next, which just goes to show the process is bigger than the person. The third area of differentiation is how active we get in our positions. What we mean by that is we're happy to tread on toes with CEOs and boards when we feel that their strategy is going skew-if and they're trying to get bigger for the sake of getting bigger. We passionately advocate for our unit holders to get the best outcome for them. We're in an interesting market at the moment where we're in the second year of what's been a spike in inflation. And so what we're seeing is for a lot of companies, we're starting to see the cost base start to increase quite a lot. That's on the back of labour inflation, which is only starting to happen now. You're seeing rents go up. The CPI increases at the beginning of the year. And so you're seeing rent go up. Power prices are increasing because as hedges roll, that's going to be a headwind, as well as you've got interest rates are going up. So any company with a bit of debt, you're starting to see that go up. So you're seeing costs go up across the board. At the same time, you're seeing the consumer starting to roll, starting to pull their horns in. And so for a lot of companies, you've got a negative impact on margins. We call it negative jaws, but that's something in an environment where you've got the market forecasting earnings growth next year across the board. We think there's going to be a lot of headwinds. So we're seeing a lot of opportunity on the short side of these companies where you've got increasing cost base and the top line starting to come under pressure where the market has yet to pick up on that. So there's some really good opportunities on the short side there. On the long side, we don't mind insurance as a sector. I liken it to the agricultural sector of 2019. At that point in time, everyone thought it was never going to rain ever again. And so everyone kept selling their agricultural stocks. We bought them pretty cheap. Insurance is on the other side of that because what you're seeing with insurance is, especially direct insurance, is that flood and water are the biggest impact on their cost base in terms of their claims inflation. If you go through a period where that reverses, and you will see costs decrease for the insurance companies at a time when they're just putting prices up. So you could see that margin expansion. But as you can see, there are opportunities both on the long and the short side. That's why a long-short strategy, there's quite a lot of relevance for that in this type of market.